Another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. I hope everyone is having a fantastic day. I wanted to talk today about what's called the Federal Reserve puts out a survey quarterly called the Senior Loan Officer Opinion Survey. I just wanted to note this, kind of really quickly in this episode. So hang on for that for just a second, but I'm very excited to announce that we actually have our first sponsor for the channel. So I want to give a shout out to today's sponsor. I'm going to bring this up real quick. So our today's sponsor is Willow Street Pictures. They have some fantastic studios where they have state-of-the-art stages. They have state-of-the-art photography equipment. If you are looking to get pet photography done, to get family portraits done, or any type of corporate work that you may need done, whether there's headshots, marketing campaigns, website, whatever your corporate needs are, they can handle it. Their studios are first class. They can basically set up for any type of environment or surrounding that you're looking to do. Their staff is absolutely wonderful to work with, and I hope you will go check them out. Their website is www.willowstreetpictures.com. Please make sure to go check them out. I highly recommend them. So, with that being said, I now want to get to today's topic. Let's see here. Being with me for 1 second. Got to get that off and flip to my other screen here. Okay, here we go. All right, so this is basically the Senior Loan Officer Survey. We can kind of go down here. Now, I'm not going to bore you guys to death with all of the rigmarole of this. I'm going to kind of hit the highlights. But what's really nice is they actually, not only does the Fed give you this survey you can get right from their website, but you can also just download the charts, which is great. So it's basically 4 pages of just all the charts from the survey. And I kind of like to look at the charts, but I want to give you the gist of this. So this survey basically tries to get an idea of like, what are bank executives saying in terms of like, where are they at right now? Like, are they tightening up? Are they lending freely? Is everything, just kind of going normal? Are they cautious? It's just to try to get a feel for what's going on out there. So here we're gonna kind of roll down through the different loan categories here. So regarding loans to businesses, survey respondents on balance reported tighter standards and weaker demand for commercial and industrial C&I loans to firms of all sizes over the fourth quarter. Furthermore, banks reported tighter standards and weaker demand for all commercial real estate CRE loan categories. For loans to households, banks on balance reported that lending standards tightened across all categories of residential real estate loans other than government residential mortgages and government-sponsored enterprise GSE eligible residential mortgages, for which standards remained basically unchanged. Meanwhile, demand weakened for all RRE loan categories. In addition, banks reported tighter standards and weaker demand for home equity lines of credits. Moreover, for credit card, auto, and other consumer loans, standards reportedly tightened and demand weakened on balance. While banks on balance reported having tightened lending standards further for most loan categories in the fourth quarter, lower net shares of banks reported tightening lending standards than in the third quarter across all categories. Banks on balance reported expecting lending standards to remain basically unchanged for C&I and RRE loans, but to tighten further for commercial real estate, credit card, and auto loans. In addition, banks reported expecting loan demand to strengthen across all loan categories and loan quality to deteriorate across most loan types. So there you kind of have it in a nutshell. So basically, what's happening here is lending standards are tightening and demand for pretty much across the board, every loan product is dropping, whether it would be consumer loans, residential mortgages, commercial loans, all the demand is dramatically weakened, and banks are really tightening the lending that they're doing out there right now. And these some of these charts and graphs that we'll look at in a second here will kind of highlight that. But I think some of the comments at the end here are really interesting. So in other words, they basically, banks are expecting that lending standards to remain basically unchanged for C&I and residential real estate loans, but to tighten further for CRE, credit card, and auto loans. So if anybody has looked at some of my other episodes on CRE, on auto loans, on credit cards, in particularly with auto loans and credit cards, you will know that basically the amount of debt outstanding right now on auto loans and credit cards has hit an all-time high. The delinquency rate on auto loans and credit cards has dramatically increased over the last year. I mean, people are really struggling to pay those bills right now. And then we are seeing a tightening around commercial real estate. Probably check out the episode I just posted on New York Community Bank in terms of what's happened and what happened to them this last week with their commercial real estate portfolio. But demands there are really tightening up in there, and banks are really starting to scrutinize some of these categories. But then in addition, banks reported expecting loan demand to strengthen across all loan categories, but however, loan quality to deteriorate across most of these loan types. So, that's interesting. So they're expecting loan demand to pick up, but they're also expecting the loan quality to deteriorate. That doesn't really help. So in other words, even if loan demand picks up, if you've got other loans deteriorating, in other words, going bad, that's not going to help. My guess is they're probably expecting loan demand to pick up if the Federal Reserve starts decreasing interest rates. If the Federal Reserve starts cutting the rates, it starts making particularly the residential mortgages a little bit more palatable to get. In other words, if that rate gets down below 7%, maybe gets back down to 6.5%, something like that, at that point, they would probably have a little bit more flexibility there to the consumer, meaning the consumer would probably have a little bit more flexibility. So some of that loan demand might pick up. I would expect loan demand to probably be pretty frothy throughout the rest of this year. And I think that the issue is going to be compounded. If the regional banks start having a lot of problems with commercial real estate, and then you have the consumer having issues with student loan debt, credit card debt, auto loans on top of all that, then that's going to be a bad brew. That's going to be a bad mix, which is really going to weigh heavily on a lot of banks and their credit portfolios. And we're really going to have to keep an eye on what plays out with that. But then just to look at some of these charts and graphs right here, we could see right here. So this is like loans to small and middle market firms, loans to small firms. We can see that number is going down. Loans to large and middle market firms, loans to small firms, October survey, again, that's going down. Loans to large and middle market firms, loans to small firms, again, October survey kind of coming back up here. And then we get down here. So here is all commercial real estate loans of all types. You could see here at the end, that thing is really starting to tail off there, again, showing the tightening. Net percentage of domestic respondents reporting stronger demand for commercial real estate loans. That's pretty tepid down there. Coming down here, net percentage of domestic respondents tightening standards for residential mortgage loans. You could see there, prime, non-traditional, subprime, all residential mortgage loans. You could see the kind of subprime really had a spike there, but then came right back down. But definitely pretty tepid for the most part there. Stronger demand for residential real estate loans. All right, let's keep going down here. Net percentage of domestic respondents tighten standards for consumer loans. Yeah, you can see that again heading downward there a little bit. Net percentage of domestic respondents reporting increased willingness to make consumer installment loans. Obviously, still below zero here, coming up just a hair, but still not great. And then finally, net percentage of domestic respondents reporting stronger demand for consumer loans. And that's kind of, still below zero, kind of coming up a little tiny bit, but still not great there. So I would definitely say so. Again, what is our big takeaway here at the end of the day? The takeaway is that basically banks are seeing a weakening demand for all loan types across the boards. They're tightening their lending standards, and they basically think that things are going to be very choppy throughout the rest of the year. They think that loan demand will pick up, provided that the Federal Reserve decreases rates, but that also they're expecting to see some of these things continue to deteriorate, i.e., auto loans, credit cards, commercial real estate. These are things that they're dramatically going to continue to keep an eye on. So, so I will keep everyone abreast as to what happens here with this particular survey. Again, this survey is a quarterly survey, comes out. So as this continues to come out the rest of the year, I will definitely let everybody know. You can go to the Federal Reserve website and check these reports out. I will make sure to put a link to this and the Federal Reserve website in the description below, so that everybody, if anybody is interested in going to check on that, they can. But again, that's kind of a wrap for this episode. So if everybody liked this, please make sure to like, subscribe, share. That always helps the channel. Please keep in mind we are on YouTube, Rumble, and all major podcast platforms. And please be sure to go and check out some of the episodes that we've got going on. And I hope to see everybody again real soon. Thanks a lot.